Hello financial fans, welcome back to another stock analysis. Today we'll be covering Microsoft, stock ticker MSFT. Microsoft is a technology company that develops, licenses and sells a wide range of software, consumer electronics and personal computers and services. The company is best known for its Windows operating system, the Microsoft Office suite and the Internet Explorer web browser. Microsoft also produces a wide range of other software for desktops and servers, including developer tools, video games, and other entertainment software, as well as software for businesses and education. Additionally, Microsoft manufactures and sells devices such as Surface laptops, Surface tablets, Xbox gaming consoles, and other accessories. Microsoft also offers online services such as Bing, LinkedIn, Outlook, and Microsoft Teams. The company also provides cloud computing servers such as Azure and Dynamics 365 to businesses and organizations. Overall, Microsoft is a technology company that produces a wide range of software, consumer electronics, and services, and also provides cloud computing services to business. The market cap is currently sitting at $1.8 trillion, and in 2022, they generated a revenue of $198.3 billion. The dividend yield is currently sitting at 1.13%. 26% of their revenue is generated from server products, 25% from Office products, 16% from Windows, 9% from gaming, 6% from search, 5% from LinkedIn, another 5% from enterprise, 5% from devices, and the remaining 3% from other revenue streams. To determine the final valuation of Microsoft, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will once again mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two ratios that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up significantly, going from $27.5 billion in 2013 to $83.3 billion in 2022. The average growth in EBIT during this period was 15.3%, meaning a 5% deduction from our margin of safety. The margin has also gone up, going from 35.3% in 2013 to 42% in 2022. The average growth in margin during this period was 2.2%, meaning another 5% deduction from our margin of safety. The next two ratios that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up from $1.12 a share in 2014 to $2.48 a share in 2022. The average growth in dividends during this period was 10.5%, meaning a 10% deduction from our margin of safety. The payout ratio is sitting at a very solid 27.4%, meaning another 5% deduction from our margin of safety. The final two ratios that we'll be looking at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. Microsoft is currently holding more cash than they have debt, so it's a 0% debt to EBITDA ratio because Microsoft has no debt, meaning a 5% deduction from our margin of safety. The return on invested capital for Microsoft is sitting at 28.5%, meaning another 5% deduction from our margin of safety. It's looking very good for Microsoft so far. Let's go look at the valuation models next to determine the intrinsic value of Microsoft. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow during this period was 18.14%. And since we're calculating the expected growth up until 2030 for Microsoft in free cash flows, I've gone with 75% of this average growth, which is 13.61%. With this percentage, we can determine the future free cash flow of Microsoft and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 9%. Out of this, we get a sum of free cash flow of $2.05 trillion. And then, to get our equity value, we have to add the cash and equivalents and subtract the debt. Out of this, we get an equity value of $2.09 trillion. And all that's left to do to get a discounted cash flow price per share is divided by the amount of shares outstanding. Out of this, then we get a discounted cash flow price per share of $281.13. With the current price of $240.22, we get an upside of $40.91, which is a 17% upside. The second model that we'll be using is the dividend discount model. I've imported the dividends going from 4 years ago to the current year. The average dividend growth during this period was 10.23%, and since we're calculating the lifetime expected growth in dividends for Microsoft, I've gone with 75% of this average growth rate, which is 8.18%. We'll once again be using a discount rate of 9% in this calculation. And out of this model, we get a discounted dividend model price per share of $328.11. And with the current price of $240.22, here we get an upside of $87.89, which is a 36.5% upside. The last model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies, looking at their stock price and their earnings per share, to determine an average PE multiple in the industry. In this case, the average PE multiple here is 23.57. And all that's left to do here to get our fair value is multiply by the earnings per share that Microsoft is generating, which is $9.29 a share. Of this model then, we get a fair value of $218.93, and with once again the current price of $240.22, here we get a downside of $21.29, which is almost a 9% downside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we have imported the discounted cash flow, discounted dividend, and multiple valuation prices per share. Out of this, we get an average of $276.06. The margin of safety we have determined earlier, using a standard margin of safety of 25%, deducting 5% for the debt to EBITDA, deducting 5% for the EBIT growth, deducting 5% for the margin growth, deducting another 5% for the return on invested capital, deducting 10% for the dividend growth, and deducting 5% for the payout ratio. This leaves us with a margin of safety of minus 10%, meaning we would pay a premium to own the stock. In this case, the fair value is $303.66, and with the current price of $240.22, we get an upside here of 26.41%. If you would not want to use this premium margin of safety, the upside would be almost 15%. If there's any other companies that you would like to see on this channel, please let me know in the comments, and thanks for watching.